Hey everybody, Dave Whitmarsh from Best Practice in HR, pulling together another session for the Benefit Education Collective. And today we have a special guest, Marc Glickman from BuddyIns. So thanks for helping us out with some content, Marc.
Yeah, happy to join you. And I know this is a big topic of interest with many out there in the benefits community or the long-term care specialist world. This is a big deal. So appreciate you allowing us to talk about it. And definitely feel free to ask questions as we go. And David, feel free to interject as well, because this doesn't have to be a formal session. I definitely want to answer questions of what the audience wants to hear about here.
Perfect. So I'll jump on, I'll be working chat. If anybody has a question, feel free to drop it into the chat, and versus the Q&A, I guess you could do either, but to tell you the truth, the chat records and the Q&A doesn't. So if I have to get back to you, it's easier if you drop it in the chat. So
Okay.
Take it away, Marc.
All right, appreciate it. And I do see some familiar faces in the attendance here. So I love to see friendly faces here. So my name is Marc Glickman. For those of you that don't know me, I am an actuary by background. So I spent about a dozen years working for the insurance companies, helping them develop products, both on the individual side, but also in the worksite marketplace. So if you have any questions about, that end of the business or how carriers are operating in the long-term care space, feel free to ask those as well. But in my recent iteration of my career, we've started a company called BuddyIns, which is a national network of long-term care specialists, other brokers and agency partners. We do a lot of joint work and referral business. And we're here to make the business of long-term care easier, right? It's not easy because it requires a lot of time and education. There's a lot of different products out there that offer a different value. And so we're convinced that there's huge demand for long-term care, and we'll talk more about why that is. But the supply of long-term care has been challenging, right? There aren't a lot of agents that specialize in it anymore. A lot of the carriers have exited the business. So what we're seeing now is a new generation of insurance products that have entered the marketplace that are becoming much more popular. And we're also seeing the demand creating supply now. So there are 53 million family caregivers today, right? People that are taking care of their spouse, their parents. 1 out of every 5 adults today in the United States is providing long-term care for a loved one. Just think about that for a second. Think about the impact that family caregiving has on employees, key employees that we're trying to attract and retain, leaving the workforce because they have to become full-time caregivers. So it's an issue that we all want to solve. Now that Medicaid is providing a lot of those benefits, some states, 40% of their entire budget for the year is going to Medicaid, which is mostly for long-term care. And so we're seeing a lot of changes afoot. So today we're going to talk about the payroll taxes that are happening, largely because there's a shortage of quality caregivers, which is increasing the cost of care. Medicaid is underfunded. And now the states are trying to figure out, how do we collect taxes to solve this gap that they can see coming down the road? So let's talk about Washington State. I'm sure if you're in the benefits world, you probably heard about what happened in Washington, even if you're not directly there yourself. But I'll give you a quick synopsis. In 2011, Washington State was interested in passing a payroll tax to fund a public long-term care program. However, the state was divided politically back then. So they were never able to get traction. The Democrats wanted it, the Republicans did not. Fast forward to 2019, the election happened, right, in 2018, and all of a sudden the state was blue. Both the legislature, the House, the Senate of Washington, and the governor, and they were able to finally get the law passed. It was the first in the nation, and it was implemented starting in 2021. And they said every single employee in the state, that's a W-2 employee, is required to pay a payroll tax, 0.58% of all their wages, their bonuses, their stock options for those that were in the tech world, right? That was pretty impactful, to fund a small public long-term care program, $36,000 maximum benefit, potentially with small CPI increases if it's sustainable. And what that ended up doing was they said, you can buy private long-term care insurance but you have to buy it before November 1st of 2021, and then you can permanently opt out of this tax. So they created this incentive to buy private insurance, but they only gave about 6 months for you to purchase your policy. Well, there are 3.5 million employees in Washington state. Last year, in basically a 4 to 6 month period, 450,000 people bought long-term care. But just think about that for a second. 15% of all the employees bought long-term care insurance. Many were in their 20s and 30s, right? And much younger to be thinking about this. To give that context, the year before, in 2020, across the entire country, 150,000 people bought long-term care nationwide. Okay, so it tripled, quadrupled the entire marketplace. Now, the weird thing happened that people didn't anticipate is you'd think that insurance companies would be delighted to have all these new customers, right? Well, they were a little bit scared. They were worried that people were going to buy the policies only to drop it the next month. They were worried that they didn't have enough administrative capacity to handle that volume, right? Which proved to be true. And so we saw almost every single carrier exit the marketplace on the individual side. So what ends up happening when you have a crush of demand for your products, it's not necessarily going to be, we can accommodate all those people. A lot of times you have limited supply. Now, what we're seeing this year is about 10 other states or so are talking about their own payroll taxes. And so we'll talk a little bit about California specifically, but to give you an idea of what those states are, New York State drafted a legislation this past summer. They're going to look at it in 2023. And currently it says that they're going to have a Washington-like payroll tax with a private opt-out, but only if you buy the policy by January 1st of the year in which that law is enacted. So if they enact the law next year, you have to buy it by the end of this year. It's almost like retroactive. You have to have your coverage. Now, we don't know if that's going to turn out to be the final law. In Washington, it was negotiated, back and forth. They wanted to make it retroactive, and they ended up making it November 1st. So there may be some time, but it's a good time to talk to your clients about long-term care. And we're starting to see a lot of demand because now that we know what happened in Washington, we're smarter about it, right? And now we're saying, well, before the carriers exit the market, before we have laws that make it retroactive, let's get in front of our clients. They want to talk about this. Once they understand the importance of long-term care planning, they actually advocate for it and they want to do enrollments for it. So New York State is one to look out for, and we are seeing some people trying to get in before the end of the year, just in case they pass this law next year. Let's talk about California, though, specifically. The proposal in California is interesting. They have a task force that's going to recommend to the legislature and the governor. It's required by law by the end of this year, and we know what that recommendation is going to look like. It's going to be a Washington state-like program that's proposed. They're going to try to make it more comprehensive than Washington, meaning that not just 36,000, they have a number of different options on the table. 72,000, 144,000 is their most comprehensive option. Just think about what type of tax they're going to need to collect to fund that, right? If it's 0.58% in Washington for 36,000, it could be 1.5%, 2% of income in California if they do end up passing something more comprehensive. So we anticipate it's going to be a much bigger impact. The other thing to think about is there's 16.5 million employees in California, right? 3.5 million in Washington, 4 or 5 times more people that are impacted by this. So in California, we're telling people, get ready now. Now, it's likely they're not going to pass this tax for 3 years. But that means that we have 3 years to work with all the products in the marketplace. We have 3 years to educate so people have time to make a decision that's important to them and not make them feel rushed because there's a fire sale going on that they have to buy right now. And we can also attract the right types of clients. Ultimately, as brokers here, we're looking out to do what's in our clients' best interest with the products that we offer, right? And whether that's life insurance or long-term care, understanding what their needs are, having them understand why they're buying the product outside of the payroll tax, that's really our goal. We are not looking to serve clients just to exit this tax because it leads to bad outcomes. To give you an idea, we actually turned down 95% of the people that came to us in Washington because they weren't buying the product for the coverage. And they were clearly signaling to us that at a moment's notice, as soon as they can, they're going to actually drop this policy which is not good for them. It's not good for the carriers. It's not good for, it's not what the state wants. So they're going to go recertify this. It's going to create a lot of legal challenges and conflicts. And we just didn't want to be a part of that mess. But there were a good percentage of people that wanted to learn about long-term care planning, were interested in doing this. And what the payroll tax does is it has people look at this sooner than they otherwise would have, which is a great thing. We're always trying to get people to be proactive about long-term care planning, because the biggest mistake you can make is waiting a little bit too long and then having a health event that disqualifies you from your best underwritten option. We're going to talk more about the group market today. There is a guaranteed issue market out there, but for clients that want substantial coverage to cover the increasing cost of care, oftentimes the individual market is going to provide that far more benefits than you might get in the group market. And we advocate for both. So I hope all that makes sense and gives you some context. Again, if you have questions about this, feel free to ask, but I want to make sure we cover other aspects of the group market today.
Hey, Mark, just before you go any further, so if you could summarize, maybe from two perspectives, right? What was the overall, maybe on a scale of 1 to 10, how successful was the legislation in Washington, and how, and to the purpose of intent, and do you see significant changes in other states to rectify some of the gaps?
I think it depends on who you ask. If you ask the state of Washington, they're going to say highly successful program. If you ask people, especially the Republican side of the aisle, they will talk about how terrible it is that people are being forced to do this and how they're collecting this tax when there's no state income tax. It's like this almost like backdoor income tax that they're able to get through in Washington state. So it's created a lot of political divide. I think of it as a success, and I'll tell you why.
Okay.
If you ask any employee in Washington if they understand what long-term care is, they do. The marketing, the awareness that this is built, I've never seen anything like this, right? Where normally we're having to explain to people about the caregiving situation, what long-term care is, why the government doesn't pay for it, all this kind of stuff. And in Washington, it's much more awareness that's been built. And we actually see people planning legitimately for long-term care, not because of the payroll tax, because they've been exposed to that knowledge. So in my ends justify the means kind of thing, I think it was a really great outcome marketing wise. In terms of the tax itself, there's a lot of questions about whether it will be sustainable. They just passed their actuarial report, and they claim that it actually is going to be the cost that they expect it to be, and everything's gung-ho. I don't know if that's really true, right? There's a lot of assumptions. I'm an actuary, so I can tell you there's a lot of assumptions that go into this stuff. But I think it's going to go forward, and it's going to be the new reality. I don't think some people think that they're going to cancel this thing. All signs suggest that they're going to plow forward and even do more things like recertify every year coverage and all this kind of stuff.
And do you happen to know offhand, and I don't mean to put you on the spot on this, but offhand, what would be the percentage of long-term insurance per person or per capita than in Washington versus the rest of the states?
Well, I'll tell you, nationwide, about 2 to 3% of the population owns long-term care insurance. Probably about 10% though of the addressable market, right? The right types of demographics. 1 out of every 10 people that has a long-term care plan, that's pretty bleak. In Washington, I guarantee you, if you consider this public program to be helping to solve that issue, which is again questionable given how limited it is, but at least they have something. Obviously, far more people in Washington have it per capita now than anywhere else. Will it change the hearts and minds and increase that percentage, from 10%? Again, depends on how you define it. But I think it is making an impact because it's our business is all about education and awareness. And if that's happening on a massive scale and people can make the right decisions to avoid an unplanned type of event in their family, I think that's a real positive economically as a whole, because the economics of having families come in and quit their jobs and sell their businesses to be caregivers is worse, in my opinion, than
100%. Yep.
the tax or even buying insurance, obviously.
Cool.
So yeah, any other questions, feel free to ask. These are great questions, and we can cover more. There's a lot in this that will only get, take an hour here, but if you do have follow-ups, you can always contact us. We'll send you some information if you do want to talk about more. Let's talk about solutions. There's a lot on this page. It tells you the market has changed. It used to be almost entirely what we call traditional standalone long-term care, which is a health insurance-based product. And it's still an important type of product in the marketplace today, but there are so many more options now, and they're great options. We're going to talk a lot about the group products out there, because in the benefit space, they're becoming the #1 option for employers, especially those that have more than 100 employees. They're going group hybrid, and we'll talk about what that means. Traditional long-term care is a very big deal. A big percentage of the market is still traditional, although the market is down overall. When you look at LTC solutions, traditional still outsells the high-end hybrid policies that have what we call an extension rider for long-term care. Now, the reason that I've singled out that type of product is that when people think about long-term care planning, they're thinking about, how do I protect the catastrophic risk of a multi-year event and a high cost of care? And what we're seeing is that traditional long-term care and products that offer an extension rider for long-term care are the most popular solution with long-term care specialists to cover that catastrophic risk. So what is a hybrid? Okay, a hybrid is generally a life insurance policy where you are allowed to accelerate the death benefit to be used for long-term care needs. There's probably 200 different varieties of hybrids in the market today. They've exploded in popularity in the last 10 years, so much so that it's very confusing as to what does hybrid actually mean. The hybrids that provide the most long-term care protection, when you run out of your life insurance death benefit that's being accelerated for long-term care, in addition to that, they provide you an extension for your long-term care that may provide you another $1 million or $2 million of coverage beyond your death benefit. Significant coverage. There's about 6 to 10 major carriers that offer these extension riders for long-term care. And because they really compete side by side with traditional long-term care, we see about 50% of those clients, especially the affluent clients that are doing, full planning, buying traditional, and 50% buying hybrids that have this extension rider attached to it. Both of those products also have what it's called compound inflation protection, mean that each year the benefits grow. So even though you might be buying a smaller amount of benefit today, if you look out 20, 30, or 40 years, you might be tripling the amount of coverage you have because it's growing guaranteed at a compound rate of return. So inside of our specialist world, those are the most popular options. Now, the bad news is that there are very few of those options that are in the group space. So we have some products that market as worksite. They're generally geared towards executives and business owners, high-end benefits, potentially tax-deductible premiums, which is really nice, right? If you're able to take a tax deduction as a business owner and you still receive the benefits tax-free. So there's actually almost like a government subsidy built into a lot of these products. But the underwriting is still going to be pretty careful because they're offering such rich protection. They're not going to accept people that have health issues. We find that the traditional and the hybrid products, on average, are going to accept about 70 or 75% of people. Unfortunately, the people that want it the most oftentimes are ones that had been declined in the past or have had health issues. And therefore, a lot of times people are coming to you when they have health issues, which obviously is not a good fit for those products. Because of the fact that those products are so careful with their underwriting, a new generation of hybrids and alternative products have come out to market. We're seeing a lot more popularity with annuity-based hybrid products, especially for clients that are 70s or even older. Maybe they've waited a long time to plan. They have maybe a few health issues, but the annuity hybrids are less strict on underwriting and still give you really great leverage and tax-free benefits. We also have a product called short-term care, which is available in about 35 to 40 states, not all states. but it's like a 1-year version of a long-term care policy with a 0-day deductible, cash benefits, a very attractive 1-year plan. And again, for people that have health issues, one of these carriers actually doesn't even have a height weight table. We run into a lot of people that can't qualify due to their build. And because of having an option for that, it's really important. The first year of a plan is an important component, right, to help the family with the longer term event. So all very important products. In the group market and with these payroll taxes, the ones that I would suggest that the benefit brokers out there or HR is thinking about offering are probably going to be 2 types. And this is what we saw in Washington be the most popular products. Group hybrid policies, so a life insurance-based policy that accelerates the death benefit for long-term care and also will extend your benefits. So if you buy a 2-year plan, if you run out of your first 2 years, they'll double your benefits and make it a 4-year plan. And so they actually do offer more long-term care leverage. However, they don't have the inflation growth. You're typically only going to get up to $100,000 or $150,000 of death benefit accelerated, which will cover a little bit of the need. You'll be co-insuring, right? Maybe 80% of it. So the first 20% is covered, 80% is not covered. Is that a good thing? I think it is. I think having a family have 20% instead of 0% makes a big difference as long as they're going to claim on those benefits and keep their policy. And these policies are fully portable. So we encourage clients to buy it. It's an affordable premium. It's guaranteed issue. Instantly get a policy. And you're going to want to pay this premium. Even when you retire or leave your employer, you'll have an individual policy at that point effectively. We're going to go through some of the price points and value of that group guaranteed issue product because it is becoming the most popular in the employer group arena. The other products to be aware of, which are important because of these payroll taxes especially, are life-focused hybrids. And the differentiation I'm making there is most of the premium that you pay for the policy is going towards the life insurance aspects of the policy, and the LTC is a secondary nice to have, but it's not really the primary reason you're buying it. We saw these two really popular in Washington because people that were forced to pay the payroll tax who were in their 20s or 30s and they wanted to get out of it, generally their needs were life insurance based. These were young families, right, that had not taken their life insurance into account yet. And this gave them an opportunity to get life insurance for the right reason. Adding the LTC rider qualified them, or we think it qualifies them in Washington to opt out. So it accomplished both needs. So there's a couple of options out there. There's a lot of life products that have acceleration riders where the life insurance is top notch. They're permanent products though. So this would be someone who wants to have a cash value product, right? Where they have an asset where you can grow it over time and have some flexibility around, having that on their balance sheet, their personal balance sheet, so to speak. But there are a lot of clients that want term products. And the one thing that lacked in Washington was there are no term products available that have an LTC rider. Largely because you don't want your life insurance to expire and to lose your LTC coverage when you need it the most, right? So there's some innovative concepts that are coming out to kind of turn a term product into a long-term care product over time. Still relatively new to the market. There aren't a lot of carriers that are offering these yet, but there is one product that we've identified that we think is going to be really important in California, which is a term product that's very competitive, and it allows you to convert within 5 years guaranteed issue to their permanent product and add that LTC rider to it. So what you can do as a strategy is say, well, if term is the right product for you in California, buy that today. And if there is a payroll tax, you may have an option here to turn a portion or all of that term product into an LTC eligible product when we find out more about what that tax is going to look like, if there's an opt-out, what the effective dates are. But at least you're solving your coverage need first, and it's not a plan you're planning to drop, right? You're buying it still for that coverage. So again, we can get pretty creative about these strategies because there are so many types of LTC products out there. But as you can picture, if you're not an LTC specialist, this is pretty overwhelming, right? All this stuff I'm talking about. So we're going to kind of simplify it and focus in on these group products for most of the rest of the time here. If you do have questions about executive carve-outs, we can talk a little bit about that as well. That's your marketplace or business owners. There are great solutions for those situations, but they're mostly individual, fully underwritten solutions. David, any
But,
questions that you have on that?
yeah, so there is one, but just out of curiosity, what is the breakdown between term and life?
Yeah, I would say that probably in the individual space, term is probably 70% purchase, and permanent products probably 30%. Mostly because of price point, right? You're going to be able to get a
Yeah.
more affordable price point for term. In the group space, of course, a lot of employers have a up to $50,000 group term type of product that they offer to all their employees as a benefit. In terms of supplemental coverage, I think it's far less frequent. But we think both are very important in the market and serve different purposes. There's a lot of different types of permanent products: universal life, whole life. There's also final expense policies that are built on whole life, meaning like they cover your funeral costs. So they're very small amounts of coverage, but very popular today. Those types of products too.
And there is a question here.
Mhm.
Do you view the states that are developing LTC programs as laboratories for a federal social insurance solution down the road?
Yeah, great question. I think one of the reasons the states are taking this on is because the federal solution failed. They actually passed something called the Class Acts back with the Affordable Care Act, Obamacare, and the industry actually lobbied to make sure that it was self-sustaining, which actually was its demise because it wasn't able to be both guaranteed issue, optional, and self-sustaining. It just doesn't work in the insurance world, especially for long-term care. And because that failed, the federal government really hasn't taken up that cause. They are doing some things to incentivize the purchase of private insurance, which is good for our industry, like allowing you to potentially take money out of your 401k pre-tax to fund long-term care insurance premiums. They already let you take money out of your HSA or HRA pre-tax up to a certain limit to fund your premiums. So you can actually do a pre-tax funding type of vehicle and still get benefits tax-free. But on the federal level, there hasn't been much traction in terms of doing a social program like this, even though, of course, Medicaid is basically half funded by federal and half funded by, the states in different ways. Great questions. So I'll continue to soldier on here, but David, if you have anything else, we can come back to these topics as well.
Will do.
Okay, let me scroll forward here. There we go. All right, so we're going to talk a little bit about the LTCI sales process for those of you that are looking to work in this world, just understanding what makes for a successful enrollment in terms of the insurance solutions. Before I do that, I want to show you some price points. And I like to just get to the bottom line. I think this is what clients want to see as well. What we did here is we put together a model to show clients in Washington, if they made X amount of dollars, let's say it's $100,000, and let's say they're a 40-year-old, how much would this payroll tax cost them over time? Okay, so what that looks like is about $48 a month in the payroll tax. If you funded that over 25 years, because you're 40 today, and let's say you retire when you're 65, you'll put into it about $21,000 into this payroll tax, with a lifetime maximum that's likely to be around $36,500, which means for every dollar that you fund your tax, you have $1.7 that the state pays for you. Now, again, a lot of people aren't going to want the state to pay for it because there may be limitations on what types of services they get or who the providers are. There's a lot of other aspects to this, but just dollar for dollar, this is usually the question people ask about the payroll taxes. Is it worth buying private insurance because I'm getting a better value? So the way we look at the private marketplace is obviously there's a lot of features to the products and benefits that are important. I would say the most important thing about long-term care insurance is it gives your family a plan. And even if you don't buy insurance, if you have a plan, it's going to avoid a lot of the devastating impacts of the unplanned family caregiver situation we talked about. But funding of that plan obviously comes into play if you're using any kind of professional caregiving or support for your family caregiver. Picture, what 4 hours of care could do, for a family member that full time, is a loved one is taking care of someone else. That's a lifeline. It's really going to help them. So we're a big believer in having some types of support and funding of that support. Now, if you pay into one of the more popular guaranteed issue hybrid products, if you're 40 years old, it's going to cost you a little under $100 a month of premium. So it's not insignificant, right? It's probably comparable to certain benefits, less than your health insurance, obviously, would probably cost. And if you pay that over 40 years until you're 80 years old, you'll have put in about $46,000. So the goal of these products is not to pay less than the payroll taxes. The goal of these plans are to get better benefits than you might get from the public program. In this case, you would get actually $100,000 initially of a death benefit. And if you use that $100,000, they'll double it, like I mentioned, and give you another 2 years of coverage. So you might get up to $200,000. They may even give you a death benefit for your family, even after you use your long-term care. So they provide a lot of different extra funding benefits. If you look at the dollars, for every dollar of premium, you have about $4.3 of protection in this scenario. Now, for different ages, it's going to look different. So like if we were to plug in someone who was born in 1992, you can see how those numbers change. A lot more into the tax, a lot less cost because, the insurance policies are less expensive when you're younger. So it becomes definitely, interestingly enough, more of a no-brainer for somebody who has a lot of years to pay the tax to buy private insurance, even though they're younger and they may be further away from thinking about planning for long-term care. Older clients too, we see a lot of benefits. Let's look at someone who's 50 years old. Okay, now you can kind of get a sense. Now here's where you start to see where these products are guaranteed issue. So for older clients that have health issues, there still can be a really good value. But this is where we're seeing more people looking at individual products from a value perspective, because you can get a lot more leverage for your dollar on these life insurance-based products if you go traditional or if you go to one of those extension product hybrids that we talked about. So hopefully this helps, just with some of the numbers. I'm an actuary, so I kind of geek out about these things. If this is of interest to you to go into more detail, happy to share this. But let's go back into the process a little bit more. Let me pull up our presentation here. So what does this process looks like if you're implementing a group long-term care solution? The most important thing to start off with, if you're talking to your clients about this, is why are they interested in offering long-term care in the first place? There's a lot of reasons to do it. If they're just interested in having an option to opt out of the payroll tax, again, I would caution you that they may not be a good fit because they may be looking to drop this as soon as the payroll tax is implemented and they buy it. You don't want someone with that mentality. It's important to find those types of employers that are doing this because they understand the value of the coverage. They understand the value of not having employees become caregivers and having them leave the workforce, and the value, as all benefits, of attracting, retaining key talent. So usually we're finding the best fits when you talk to HR are people that have had their own personal experience. And guess what HR knows a lot about? They see this happening. The employees come to them when they're caregivers, right? What EAP benefits do we have? Those kind of things. And usually when you open up the conversation, you talk about the 53 million family caregivers, you have HR that cares about what you're talking about. At the end of the day, though, it comes down to dollars and cents. So first, it's establishing that need. It's understanding, the why factor as to why this is important for the business. But then you have to prove that it's worth the money. So you kind of have to have both hats on when you're doing this. So when you're analyzing your options, we're finding these group products are popular because they're much more convenient to offer than the fully underwritten solutions. Guaranteed issue products obviously are not going to have that underwriting component. And there's a lot of enrollment platforms now that are self-service. And so it's easier to do business with the carriers than it used to be, which is great. We find that probably 3 times more employees want to buy group solutions than individual, just because of the convenience. Process, right, is a big part of the new product. So the value is oftentimes the process itself. The other reason why they're attractive is because these products are designed, even though they're life insurance based, to cover long-term care now. The fact that you have that extension rider that I mentioned, that doubling of the death benefit, The fact that, you can use that for a variety of different services and it's portable. They've really designed these products in smarter ways that allow you to have this foundational plan, even if it's a small amount of coverage relative to the overall cost of care. And once the employee owns that, they're much more likely to think about supplementing that coverage in the future with more robust coverage. So we think of it as a great way to get your foot in the door, to get people doing something, even if it's minimal, and then having a relationship that we can build over time. The reason people participate in long-term care involves education. Once they learn about the issues, they start to realize how much it's impacted their lives and how much them as a caregiver, they don't want to be putting that same burden on their kids, right? It's the reason why people buy life, disability, long-term care is exactly the same way. Most people are doing it to protect their families. And when you educate them on those facts and they understand and believe and have that know, like, trust factor with you, that's where you get more people to participate. So what makes a good enrollment different from a very unsuccessful enrollment all has to do with how much education that you're allowed to do and how effectively do you do that. In fact, at Buddy, we will not do an enrollment unless the employer gives us the microphone and allows us to not only do email education, but also webinars that we can record for employees, because otherwise nobody participates. We've seen groups that are like 2,000 plus, where that broker did not do the education. They couldn't even hit the minimum of 10 lives to get the product offered. And the carrier had to go back to the broker and say, like, sorry, you can't even offer it to those 9 people because you didn't get the minimum of 10. And you can tell that, the education just was not done or was not done effectively in situations where, think about that participation rate. It's so low that, like, how could that be happening? So when we're doing enrollments, we typically expect about 10 to 20% of people to participate. The average, though, is probably 2 to 5. Okay, so that's what you should expect. If it's employer funded, guess what? Participation rates look like they skyrocket. If you're buying a base policy for everybody, obviously you're getting a lot of participation. Most of the people are participating. But any degree of employer funding goes a long way. So the hard part, of course, is everyone's competing for, HR dollars, right? And getting the, key people and the business owners to get on board with that. You have to work out, how do you make it cost effective for them? So when we're analyzing options, we're oftentimes figuring out, how do we best spend the employer's money in addition to what the employees may want to buy themselves? And we probably do more employer funded solutions than most firms out there, because we put such an emphasis on having the employer put some skin in the game, but we make it really low cost and cost effective for them to do that. With individual solutions, when the employer pays for the employees, it's tax deductible as a business expense, which is nice. With the hybrid solutions, it could be tax deductible, but it's going to be income for the employee if you're doing it on a life insurance-based product that's guaranteed issue, typically. So just some nuance there. David, do you have any questions about that? I see you following along, but let me know if you have anything you want to.
No, I don't, but I was curious though. You said about 5%. So when it is employee or the employer contributes, what is the ranges that moves up to?
Well, if it's a partial contribution, I would say it will double whatever your participation would have been otherwise. If it's funding a full base plan, then you're going to end up getting, almost everyone, because it's pretty silly to not take the free insurance that your employer is offering, right? We do some people that are
When
not
your only
actually
downfall
enrolling
is
themselves in
paying
that.
taxes on it, right?
Yeah, so it's not 100% though. There are some people that don't do that. And then when there's a payroll tax involved, we saw participation rates in Washington in the 40% range. So kind of like the employer funding scenario plus extra incentive, because not only were they getting it from their employer, but all of their friends in Washington were also impacted. And there was a lot of more than just the water cooler talk, right? This is like talking with just your friends and how they're dealing with this. I will mention that because of what happened in Washington, we are starting to see a big resurgence in group long-term care. So I'll give you some numbers. One of the carriers that sold the most long-term care in Washington was a group carrier. They did over 100 million of premium just in Washington last year. This year, they're also going to do over 100 million though. That surprised me. There's no active payroll tax. It's just being proactive, like we've talked about with these other states. The reason they're doing so much is because of the awareness Washington brought. Disney employees in Washington enrolled. Now the Disney employees in California are enrolling. Okay. So all the tech companies in Seattle are now enrolling their employees elsewhere. So because of the awareness it brought, because they had done it anyway, because they want to get ahead of whatever happens in the other states, we're seeing a lot more enrollments going on this year than any year prior. And I expect that to continue to be the trend. It's going to continue to pick up and be more and more. So a lot of interesting side effects of what Washington did. I'll cover just briefly carve-outs. Like I said, we could do a whole nother session on this topic. What a carve-out is a, and this is a long-term care carve-out, is a plan that you offer to just specific employees. Long-term care, unlike other benefits, allows you to pick and choose as an employer who you want to offer it to. It does not require discrimination testing. Generally, you can do it in a way that's really easy, even if it's an ERISA plan. You just add like a paragraph, to your current ERISA documentation. So there's not a lot of headaches there. And so we see plans that are designed just for like closely held business owners who are going to do long-term care anyway. The advantage for them is if they pay the premium and use the business checkbook to fund it, which oftentimes is more attractive anyway, they can actually deduct it because either all or a portion of those policies can be treated like health insurance. And with your health insurance, you can deduct it, whether you're a C corporation or whether you're a self-employed business owner, you're allowed to deduct it on the first dollar. Now, there's some nuances. There may be some limits if you're self-employed and how much you can deduct each year. But it's always going to be worth doing because you're getting the value of the products. Plus, on top of that, you're getting additional tax savings for your business. And you're still receiving tax-free benefits. So it's very rare, right, in our profession in the insurance world where you can double dip, right, where you get free tax dollars that we're using and also tax-free benefits that we're receiving, and you never get taxed if you're handling long-term care insurance this way. So carve-outs can also mean not just for the business owner, but let's say I have this group of 10 key executives and we want to reward, attract, retain them. It's a great way to do it is through long-term care insurance, right? Because you get the tax deductions for the business, and if the employee stays with the company, they continue to receive this benefit each year, and you can design it typically as a 10-year program. So you're paying those premiums over 10 years. At the end of the 10 years, they're fully paid up. They take with them their long-term care policy into retirement, and they've received this, additional benefit to protect, what would have been their pension, but now their 401k right into the future. So it's an opportunity out there with even just working with the business owner, getting their own personal policy. Once you own long-term care, then you start to think about other people that should also own it, right? I myself, I just got my long-term care policy, 39 years old. Happened to be in California, so nice to get ahead of that payroll tax. Deducted it through our BuddyIns through our business, had them pay the premium and deducted it as health insurance. Obviously we're in this business, so of course we own long-term care. We're probably going to get another hybrid policy on top of the traditional policy we bought. But now that we own it, right, and we're talking to our clients and our partners, right, you pull out your policy, right, that has a lot more weight to it when you're offering it to clients. And that's the same thing with business owners. When they own it, they start offering it. They want to offer it to their executives, their employees too. So it's a great way to build a relationship. I'm not going to talk too much more about it, but I will show you the value on the individual market real quick. Again, we have our software program here. I'm going to look at a 50-year-old, and we looked at that situation on the group side, I think, when we last, let's take a look. So 50 years old, $171 a month with the group products. We go to that individual product, not going to be less expensive, but you can get a lot more insurance leverage for your dollar because these benefits are growing with that inflation protection growth. When we look at this relative to the cost of care, so I'll pull up the cost of care here. This is actually, I just chose Illinois just as an example here, but this is what home health care costs today. $5,300 a month is the median cost. We look at 4% growth, and it's probably going to be more like 5%, 6% with inflation where it's at right now. But let's just be conservative at 4%. If you look out to age 85, the cost of care, the median cost of care is going to be $21,000. So our individual plan is covering about 80% of that cost. This is why people buy individual, right? We looked at the group plan. This is about 200,000. We look at the individual side, we're getting another $1 million of coverage for a multi-year type of event. So this would be like a 6-year plan. If you're able to take that tax deduction on the premiums, even better. Not too expensive though. This is the average premium of what people pay for traditional long-term care today. For your higher earners, it's going to be a lot more affordable than the people that are paycheck to paycheck. Obviously, they're not going to be as good of a fit for this. But again, a good value that's out there in the market. We oftentimes will compare this to self-funding. Now, if we self-fund and we're looking at a bond type of investment, right? A safe type of investment. If you were to invest those same dollars at 6%, this is what you'd have in your investment account. So you can kind of see the trade-offs. With long-term care, you'll have more tax-free protection, but if you don't use it, you won't get anything back for this. Whereas if you self-fund, quote unquote, you'll get less leverage, but you'll have this account value to do what you want with. But that's kind of a blessing and a curse. If you don't allocate these dollars towards long-term care plans, a lot of times your kids may not spend this money on your care still. So you still want to make sure that you're getting the right type of care. If you have to pay, with after-tax dollars, you can see how much taxes might take out of an investment. So you get an idea of why people are buying long-term care from a value perspective. Still better on the group market too than what you can get, self-funding, but a little bit different value where you have that death benefit. If you don't use long-term care, you get at least your death benefit. Again, I can cover more of this if there's interest, but I'm probably going a little bit into the weeds. So I'm going to try to get out of the weeds a little bit unless you guys have questions.
No questions yet.
Okay.
Yeah, just drop them in the chat or in the Q&A. But happily answer those.
Okay. Well, this is not a commercial for Buddy, so I'm not going to make it a commercial, but I do want to share with you, if you do have questions about this, you can go to our website, buddyins.com/partner, and you fill out the form. You can meet with me or someone on our team to chat about long-term care. We're here to educate. That's our primary mission here, is education, awareness, making it easier to do long-term care. You do not have to partner with us for us to help you and provide resources. We provide a lot of free resources, education, technology, and then we do partner with people and we split commissions because we're licensed in all 50 states to do it. But if you have an existing provider or you're offering long-term care, there's no obligation to work with us. So with that, David, let me open up to you. If you have anything else, and I'll leave it a couple, 10 more minutes here, just in case we want to have more of a conversation.
Yeah, no, I don't have any additional questions. To tell you the truth, it's not in my area of expertise, so I can't throw you back in the weeds. Yeah, I was surprised with just some of the statistics as far as percentages. I would have thought they would have been a lot higher, just by nature, right?
You're talking about participation?
Yeah, participation rates. Yeah.
It's interesting. If we're offering long-term care on a totally voluntary basis, it's surprising when HR does a program and nobody signs up and they're just shocked. Why didn't that happen? And what it comes down to is $100 a month, right? For a lot of employees is not going to be something that they're willing to spend unless they have a personal experience. So I think, and then of course you have to educate for them to even know that they have a personal experience. And it's a lot about timing. So think about when you offer this year over year, your participation rates actually tend to increase over time with long-term care. Because it may not be the first year you're doing it because you're only educating over maybe a few weeks. Yeah. It's not a dedicated effort or it's part of open enrollment. But then they do it the next year, and the next year, and then they're like, wait, what is this long-term care thing about that we're offering each year? And that's what we see in the entire marketplace, is it just takes time. And sometimes it's situational, right? That life event happens, and then it's kind of like that light bulb moment. On average, we see it takes about people 24 months between the time they learn about planning and long-term care insurance and they buy. 40% of people buy after 2 years. So it's just that consistency, exposure, that trust building. And for us, we actually do a lot of education through marketing, where we're emailing them every month, just information, education, not sales, just so like 2 years from now, they'll be like, oh, okay, now I understand what that's about, because it just happened to my brother, my sister, my father, mother, aunt, uncle, spouse, like somebody is impacted. And then they say, okay, I know, I want to talk to you about this. So it's not as surprising as it might seem, but when you go through this year over year, then you start to see that higher participation starting to occur.
Because I'm pretty sure, like, you don't have to be an actuary to figure this out, but the death, your likelihood of dying at some point is pretty high, right?
Yeah.
So and there are costs and families and things that are associated with it. So it shocked me that it was that low, to be honest.
Yeah, well, I'll tell you, and I don't go into statistics a lot, because more often it's about the personal experience, the stories, the really understanding and feeling the emotional impact of this. But if you look at, some surveys, like where you need like at least a day of care at some point in your life, 90% of couples, one of the two of them is going to need long-term care at some point.
Yeah.
So it's a very high percentage of people that need it at some point in their lives. Needing it for a long period of time, though, obviously that's a much lower percentage. But there's still a good number of people that need care for 5 or more years, and it's growing because Alzheimer's and dementia is the #1 cause and cost of long-term care today. And it's the only major condition where there haven't been significant medical advances in delaying or curing it. And your brain's an organ, just like everything else.
Yep.
So I think that's the biggest part of this epidemic that you're going to see, is care, not just more frequent, but more longer, right? And for caregivers, it's really a slippery slope, because you start off by just helping your parents with their groceries, right? Or stopping by every once in a while. And then all of a sudden it gets worse, and progressively worse. And then you have to step in and do more. And then you kind of feel like you're trapped, because now you're the caregiver. And they have this theory, they call it caregiver identity. Like, do you picture yourself as a son or daughter, or do you picture yourself as a caregiver? And at a certain point, when you're providing more care, you lose your son or daughter identity, and you become more of a caregiver, because almost out of necessity. And it's hard to get out of that situation, once you start it. So I think helping people understand that, there are better ways to plan than having, people who are not professionally trained to do this be caregivers, let alone like your spouse. Like, could I picture an 80-year-old and then their spouse, who's also 80, right, is taking care of them, the physical toll that takes. It doesn't make sense. So those are the kind of things that you kind of get into the weeds on with the reality of this. But that personal story is what drives people, because they're like, that's what they picture, right, their future to be. And so you talk about, we talk a lot about personal stories, and that's usually why people take action at the end of the day to do this type of funding.
That's awesome.
Yeah. All right. Well,
that's all I got.
I know we could talk a long time. I'll let you guys with a few minutes here extra. If you do want to learn more about these payroll taxes, you can always go to our website. And we actually have an article we wrote on both all the payroll taxes that are happening nationwide. So if you go to BuddyIns.com and go to our learning center, you can even search in the search bar for this article. We have all the state kind of updates here. And we have a special article just for California. And we're talking about the different things that are going on in California. We keep that up to date every month. So
good. And if you're listening to this, I'll depending on where you downloaded it, or so, I'll try to drop that link into the description below, so you can get to it easy.
Okay, I'll plug it in the chat here, and you can just pick it up, and anybody that's on here can can just go right to that link. It
Wonderful.
goes only to the host or panelist. Let me see if I can send it to everyone. Hold on. There you go. So you guys should be able to see it in the chat now. So this is the all-state article. If you really want the California specific one, which is linked in there, I'll put the separate one in there too for just California.
Perfect.
All right. Well, thanks everyone for the time and appreciate you having me on, David. Happy to do this anytime. So
That's great. Thank you very much, Mark. Everybody enjoy your day. Thank you.
talk to you soon. Bye.